This chart is pointing to, it really, from a technical standpoint, it's pointing to $8 or 8%, which is huge. If that happens, obviously we're going to have like a massive financial crisis, which I do believe is coming. And we're really at a critical tipping point here.
Chris, thank you so much for joining us today. Well, here we are in the month of August. I can't believe it, but I'm sure you would agree with me when I say it's been one hell of a year thus far, and there's just so much going on in the world. We still have hostilities in Ukraine and also the Middle East. We still have trade wars going on with the U.S. and China, and also the U.S. and Canada and many other countries. We just had a Fed meeting. Rates were unchanged, but Powell did discuss he's still very concerned with the economy and also with inflation and the impact tariffs will have on inflation. And despite all these negative events or headlines that I just mentioned, the market continues to power forward. The S&P and the NASDAQ are making new all-time highs like every other day. And I want to start right here and just get your view on what's happening in the U.S. with the U.S. markets. Should we go all in on equities or should we start raising cash? What's your view?
Yeah, I mean, we're really at a critical tipping point here. So the stock market had a bit of a breakdown about a week and a half ago. High volume selling, a lot of things underneath the hood of the market. A lot of technicals actually broke down temporarily. And that was a sign of some weakness. And I mean, if we take a look at the trend, this is the SPY ETF. You can see here we had the early year sell-off, which, the market, the technicals told us to get out. Eventually the bounce turned into a rally, told us to get back in. And last week, the market said, hey, get out of this. Now, this is the same for the S&P 500 and the NASDAQ, the QQQ. So right now, we're on the sidelines. We've locked in kind of right up near the highs. And the market is trying to tell us, trying to figure out, are we going to kick back into an uptrend and reload and be able to scale out as we hit more targets? Or is it going to actually roll over and sell off, kind of like what we saw last year? In fact, check this out, James. So I was looking at last year. The top chart is the QQQ for this year. We have this April big sell-off, the low, and we've had just the breakdown of last week. Look at 2024. We had the April low last year, and almost in the exact same time frame, we had the same type of technical breakdown, and it led to about a 15% correction down to the April lows. Now, the April lows from where we are this year are more like 25% away. So I'm not saying this is going to happen, but it's a very interesting scenario we have going on. And the market right now, this recent drift up as the market's poking to new all-time highs pretty much today, as you and I are speaking, that is kind of Magnificent Seven driven. The underlying stocks are actually very, very weak, which is what our strategy is telling us and why we have those red bars. But there's a handful of stocks keeping things going higher. So the market is on the cusp of starting another leg higher, probably Magnificent Seven driven, or it is about to roll over. And that's what we're kind of just waiting to see how that is going to happen. And that's kind of my take for the markets is this is the tipping point this week. Got to figure out where things are going. We're on the sidelines. Sometimes sitting on your hands is the best thing to do and wait for a confirmed trend before you take action.
So you think we're at an inflection point? It could go one way or the other.
Yeah, exactly. And we just have to wait. We have a strategy for which way it goes. We just need the technicals to confirm. Is it a bullish strategy or do we move to a defensive kind of a bearish strategy?
And when I look at the market myself, I mean, I have to admit, back in April, I got shaken out of the market. I was sitting on a lot of cash. Thankfully, I'm long some gold stocks, but we had that big pullback in April, especially after Liberation Day, and sold a lot of my U.S. names. But here we are, the market's up 20% from its lows. And then if you look at a lot of the high beta names like NVIDIA, for example, it's up significantly more. I missed out on that. How do you know you're not in one of these scenarios right now where we might get a little bit pulled back, but then the thing's just going to power forward going into year end?
Yeah, well, that's a good question. And the reality is no one knows, like none of us know. It's just who has the best strategy to follow price. So once it starts to roll over, we know to step aside. And if it turns back up, who's got a strategy to clearly and as early as possible identify a new strong uptrend? And that's where most people struggle is they don't have an exit strategy, and we just never know how far this market is going to pull back. Like any one of these pullbacks in the market at any given time could be like a 1 or 3 or 5%, or it could be a 55% correction that takes 10 years to recover or longer. And so that's what I focus on is I don't really, nobody knows what's going to happen. So we have a strategy. If it rolls over, we get out and we make sure we're not going to be, caught holding a falling knife in this market. And if it turns back up, we get long again. And so that's the way you have to really look at these markets. And the buy the dip mentality is so strong still right now. Every dip, people are like, no, we're going to all-time highs. We're going to keep going. Don't fight the Fed, don't fight, QE and all that stuff. And, yeah, it does make sense to some regard, but eventually one of those dips is going to be the one that slaughters all the buy the dippers, and they're all going to be suffering dramatically. And so that's what I avoid is I don't want to be, I don't want to give back half my money and get stuck in a trap where you're down so far, so much. You're like, I can't get out of this now.
But at the same time, you're missing out on a lot of the upside, because if you look at the last 5 years, anytime we had a significant pullback, it was always a buying opportunity. April is a case in point. Why not just get long and stay long?
Well, eventually, here's the thing. Who I'm focusing on and protecting I do this whole strategy for my own capital, but more or less, if you are close to retirement or retired, eventually one of these is going to be a 50+% correction that takes a decade to recover. And yes, buying the dip will work over a 40-year window, no problem. But if you're 85, you don't have 40 years or 10 years to just give away half of your wealth and the suffering and the worries that come with that. So if you just follow price action, you know when to get out, you know when to get back in. In fact, we got out here and we were able to buy back in at like 6% lower price. So moving in and out isn't always costly. In fact, it can not only allow us to profit from falling pricing, but then we can buy things back at a cheaper price like we did this year. So it really comes down to how nimble and how good of a strategy you have to identify these waves that roll through the market. But there's no doubt long term you can buy and hold. But the thing is, if you have wealth, you've got a good lifestyle and you're a bit older, you definitely don't want to give back half of it or more potentially, and then have 10 years of stress and strain and sleepless nights worrying, if you're going to run out of money or how long the recovery is going to take. So I have no problems moving in and out. I also have no problems sitting on cash, watching markets rally without me sometimes. That's just part of the game. I don't get FOMO. I know there's always going to be another opportunity in the markets. It'll pause and pull back and create another opportunity to get in. There's always going to be different commodities. So the mentality that most people have is they always have to be in the market. They have to make as much as they can. They feel more pain when they miss out on watching the markets move up than they do actually holding a loss. There's all kinds of studies that say FOMO is more painful than just taking a huge beating on your account. And it's true. If you can get over that and realize there's always going to be another opportunity and the next pause or pullback will be that opportunity to reload and get back in, the market's become not that stressful. But everybody's been brainwashed to think you need to trade a lot. You always have to be in the markets. If you don't buy the dips or you don't hold it, you're going to miss out on gains. And put it this way, there's no easy way to navigate the markets. It's taken me like almost 30 years to really nail them down and become very efficient in them. And even the best still struggle. So you're going to miss on some rallies and you're going to get out of trades too early in some points, but it's just part of the game, and you just have to accept that's how it is.
Many of our interviews delve into investments you can only achieve by being an accredited investor. By signing up to our accredited investor list through the link in the description below, you'll get our 15 full-length Rick Rule Symposium interviews for free, plus our free reports on investing in rare earths, uranium, and copper, some of the hottest metals right now.
So we're looking at NVIDIA right now. It's the first company to go through $4 trillion. To me, that chart looks amazing. What's your view?
Yeah, there's no doubt it's muscling its way higher. It's a series of pauses and pullbacks, of little bull flags. I mean, it's pointing to higher pricing, and this is the thing. If we look at the Magnificent Seven as a basket, it's very much so like in NVIDIA. Really, it's up and to the right, it's breaking out to new highs. These 7 stocks are going to drag the indices sharply higher, and they're almost all in bullish trends. We got Tesla, we got Meta, all of these breaking out and showing reversals to the upside. So this is what could make this market generate a new buy signal here potentially this week and continue to go up.
Yeah, and we're pretty well through Q2 earnings season, and they've all reported, especially the Meg 7. They all came out and they're spending billions and billions of dollars on CapEx going into data centers, et cetera. So that's driving NVIDIA. I think it's the last one to report here. I'm not too sure, sometime later this month. But I think that's what's driving these names. And then, of course, you mentioned the fear of missing out. Well, you got institutional investors all over the world, right? You only have 5 months left of the year. And if you're behind in terms of performance, you're going to be jumping on this bandwagon.
Yep. Well, we're coming into an interesting point from a seasonality wise standpoint. Stocks are going to want to start to sell off, going into, towards as we get closer to October. So it'll be very interesting to see how that plays out. But when we look at a bunch of these Magnificent Seven, Tesla's put in a bottom, it's put in a bull flag. It looks like it's starting to turn higher. I mean, we can look at Apple has had a big pop in reversal, showing huge $100 billion infrastructure, all that stuff going in. We've got Meta. All these are really starting to move higher. Meta's got a tight bull flag pattern pointing to probably like $850 a share if it pops and breaks from here. So this could all of these Mag 7s are ready to roll to the upside, and they're going to drag the NASDAQ most specifically higher. And get everybody very bullish. And this is the one thing with these heavyweights. It really only takes if somebody is manipulating the markets and want to keep them higher, they just have to focus on these 7 stocks and just manipulate those stock prices. It doesn't matter what the rest of the stock market is doing. The rest of the stock market really isn't that strong. But all you got to do is keep these few stocks moving higher, and the whole market's going to keep going up and making everybody look good. And,
I don't even think it has anything to do with manipulation. It's just trillions of dollars chasing these names. I read an article recently about the level of concentration right now in the Meg 7 represents, I think, $20 trillion collectively, and it's about 37% of the S&P. So massive concentration, and you just got to be there. If your benchmark
I agree.
is the S&P,
I don't think
you got to be there.
Yeah, I don't think it's so much manipulation either. I think there's potential where that happens in scenarios, but you're right. This is the thing. What I see is a lot of FOMO right now in the markets. A lot of investors who missed this rally are now have extreme FOMO, and they're starting to move in, and the Magnificent Seven are catching all of their attention. And so all that FOMO money, instead of going into more speculative plays, they are just moving into these Magnificent Seven. So the FOMO is driven and focused in these, driving them higher. And I mean, that's why this market could potentially scream, some more new all-time highs over the next month or so, depending on how this unfolds.
Chris, the other sector that is really standing out to me are the financials. And I want to take a look at JPMorgan, okay? It's the largest bank in the U.S. I think it's around $800 billion in terms of market cap. It's up. It's at an amazing year. It's up 20%, trading at all-time highs. What's your take on that?
I'm not a fan of the chart pattern at the moment for it. If we were to look at it, it does have, you'll notice some of the high volume bars on the bottom, a lot of they're red, which tends to, we saw back over here as well, as the market kind of put in this initial kind of breakdown and it went into a deeper downtrend. So this looks a little bit bearish. This looks like it might want to actually drop and flush down a bit more. Now, mind you, it's still in an uptrend. It's still holding above this blue 50-day moving average. It's not the sexiest looking chart, but there's no doubt it is in a long-term uptrend. Short-term wise, there's a little bit of selling going on. So I'd be a little bit nervous. I'd like to see it get back above this high, probably about 295, 296. If it can close above that, then I'd be like, okay, it looks like it's probably kicking back into an uptrend. But short-term wise, it is kind of stuck in a little bit of a downtrend, and there's some high volume selling going on. So somebody's locking in profits or dumping some shares, and want to see that come to an end and price turn up. So I'm not a huge fan of that one.
And why don't we take a look at Goldman Sachs? It's also trading at or near all-time highs. It's up 25% on the year.
Yeah, it looks similar. It's holding up nicer. It's above this pink line, this magenta line, which is the 20-day, which means we're in a very nice, strong uptrend. It's consolidating sideways. So if the market does have a bump higher here, we're probably going to see all of these stocks move higher. This is primed and ready for a pretty big move to the upside. we can get some traction. So it still looks good. Again, it has very similar price action in terms of it. It did have some heavy volume selling down to these lows. It's bounced back up. It keeps opening higher and then selling off each day. That's what these red bars are. That's telling us that every time the market opens higher, somebody's dumping shares and selling into that. They're lightening their portfolio or locking in profits. It's not a bad thing, but it's just a warning sign to be like, okay, it's at resistance here. And somebody's unloading their portfolio until they're done selling off what they need to. It might continue to be under a little bit of pressure or not break out just yet. But again, it's in a strong uptrend and it is pointing to higher prices at this point.
And just because you and I are based in Toronto, why don't we take a look at Royal Bank? It's Canada's largest bank. Market cap's around 200 billion, significantly smaller than JPMorgan, but nonetheless, it is also trading at all-time highs.
Yeah. Yeah, I mean, it's had a really nice pop and rally in the past week or so. So hitting all-time highs. Again, these are in some strong uptrends. And I do think eventually there's going to be a lot of pain in the financials if we go into a financial reset. Obviously, the banks are the ones holding most of the debt and the issues here. So I think they will be one of the most hit. But overall, they're in a strong uptrend. We're seeing RBC hit a new stock. We really have a nice momentum move to the upside. It is pointing to higher pricing as well. So yeah, most of the stock market is in this limbo mode, but the financials, RBC specifically looks the strongest because it's moving higher, where the other two listed on the Toronto or the New York Stock Exchange they're kind of, going sideways. So we're definitely seeing money move into the Canadian market, into Canadian stocks and RBC at this point.
I guess the one thing that stands out to me when I look at these financials, they're really a reflection of what's happening on the economy because they cover so many different aspects of the economy. If you look at JPMorgan or Royal Bank, they have both retail and commercial clients. They have residential and commercial real estate loans. And so if there was any sign of weakness in the economy, it would show up in their loan portfolio, and it doesn't appear to be.
Yeah, I don't know. I mean, yeah, they definitely have the whole spectrum of the business, but I'm from a fundamental standpoint, it makes good sense. But stock prices are always funny how they move. A lot of times they'll move in the opposite direction. The way I actually see it is I think the banks keep getting overextended and they're hanging on to more and more debt and credit, defaults are picking up and all that stuff. And usually the stock prices and the masses are usually kind of doing the opposite. They're going in the wrong direction. So I'm not very bullish on the banks, from a fundamental standpoint. I think eventually they're really going to suffer. But people move into them because, more or less the trend is up. People chase trends. And banks are making some good money. I mean, everybody just keeps jacking up their pricing and has bigger profit margins. I watched this, read this article a while ago, about a couple of weeks ago, and they were showing the profit margins for businesses, and it has skyrocketed. Like everybody initially was thinking, oh, COVID's jacked up the price for materials and products and labor and all this stuff. And of course that gets passed on to the end user. But when you look at the profit margins, yeah, sure, the prices of things have gone up to produce and to provide the services, but the amount that people have jacked up their pricing themselves are massive. The profit margins have just exploded. And I think the banking system is similar to this. Everybody's kind of gouging for prices for things. And so there's huge profit margins. Eventually, I think the music will stop. There'll be a reset. But you're right. They're moving higher. The people are chasing. It's funny. A lot of Canadians are always very, very heavy on the banking sector, on the banks. Every time I talk to somebody in Canada, they hold so much in the banking system. I think it's because we have a fairly small market in Canada. And these are some of the biggest companies and they want to be involved in them. They pay dividends. So it just naturally attracts people, even though I don't think they're really the best or the safest play. But the markets are kind of designed to pull you into generally some high risk opportunities or higher risk than you think.
Yeah, the thing about the banks, they nickel and dime you to death.
Totally.
So we looked at tech, so we look at the financials. Why don't we look at gold? Gold has been a massive outperformer here. It was up 25% in 2024. We're already 8 months into the year. It's up another 25 to 30%. What is your take on gold? You must be bullish.
I am bullish on gold and I'm looking to get long gold, but not yet. I'm waiting for it to break out and show some confirmation. And while you look at this futures chart of gold and you say, well, here's a high back over here and it broke out, only 2 sessions ago from this talk to all-time highs. To me, it hasn't really broken out yet. As you know, there's different markets that gold trades through, like the London Exchange. And so if we look at gold in regular trading hours only, we'll just go to GLD, but any like the Sprott Physical Gold Fund, all of those are the same in terms of they show price action from 9:30 to 4 regular trading hours. That's when the majority of volume is traded, and to me that's the core price action. Gold is nowhere breaking out to these highs. I actually want to see this ETF close at some new all-time highs, and I'll actually be really bullish, potentially jumping in for a long trade, because I think gold has about an 18% rally to the next move. And there's an interesting scenario back in 2007. We had a very similar scenario where gold had about a 20% upside and it ended up going about 37%. I have the charts here. There's an interesting chart. So there's two here. The left chart is the S&P 500 weekly chart. This is in 2007. This was the 2007 stock market top. So the market put in a little top. It had a big correction, rebounded back, and then it broke to a nominal new high. And at that time, gold was one of the top performers, kind of like what we have right now. If we look on the right-hand chart, this is where we are now, the S&P 500. We put in this high, and then we came, and now we broke to this nominal new high. Gold is trading up, outperforming, being one of the number one assets, just like it was back in 2007. What's really interesting is if we were to look at the stock market, it eventually starts to fall and has a big correction. The stock market falls about 20% and gold rallied 37%. And we're in this perfect storm scenario where we could see the same thing, the stock market, if the Magnificent Seven don't, trumpet and suck the markets higher with just the heavyweight that they are, the stock market could very easily have this big correction and gold shoots higher as that defensive play. So I like gold. I think we're very close to that turning point. That's kind of what I'm keeping my eyes on, is what is the stock market going to do? And we're at this tipping point, and we just have to kind of wait it out and navigate this potential top over the next week or so.
So I got to push back a little bit here, because you said you're waiting for it to break out. And we just saw gold go from $2,000 an ounce to $3,500. I mean, yep. It took a while to get through that $2,000 level. It came up there, it probably took 2 or 3 years, but it finally broke out.
Yes.
Why wouldn't you have been long?
Well, yeah. I mean, we have. Depending on your style, your time frame. So, for example, like whenever I buy physical metals, I buy them at beginnings of new cycles. I don't know if this chart will load all the way back down, but 2008, 2009 was the start of a massive super cycle. 2019 was the next one, and I believe we're going to continue to go see. I think this is still like on the move up. I think we're going to about 4,100, if not even higher, for gold. I hold gold. I'm saying what I like about gold here from a more of a trader standpoint. I like this bull flag pattern. If it starts to break up, I want to jump in on it because I think there's 15 to 20+% upside as a trade. I think people should be holding gold and long term. I think it's a very good play. So I don't know if that answers your question or not, but that's how I see it.
And I guess the other interesting component about gold is that we finally saw the equities come alive here this year.
Yes.
And so why don't we take a look at those, beginning with Newmont. Newmont's up 80%. Okay. Believe it or not, it's up 80% on the year. Back in December or January, you could have bought this stock when it was down on the year. Just had a massive move. And this tells me we have generalists coming into the marketplace now, because this is one of the few. This is the only gold name in the S&P 500.
Yeah, I mean, it's definitely popped and rallied to the upside. This is what's really interesting is we've seen gold trade sideways, but the gold miners have popped and broken out. So that is a really good sign. That's telling me that we should see physical gold follow suit and move higher. We saw the same with GDX, GDXJ, and silver miners. They're all doing very similar price action. Newmont is, as you said, it's kind of that one in the indice that attracts those investors to move into it. When you look at the monthly chart, as you know, you can go way back here in time. It has been all over the place. Really, it hasn't even, it's a noisy chart. I'm not a fan of Newmont so much myself, just because it's getting up to nosebleed territory that it has been sold off, almost every time it gets up here, it sells off in a huge way. So money's definitely moving into it. I would almost call it a bit of a short-term contrarian play. When the masses move into it, usually that move is about done for that stock. So I don't like something that channels sideways like this in a 35-year channel. I'd rather get into something that has a strong movement, is near all-time highs, and hasn't been up at these levels and sold off. But there's no doubt Newmont has lots of volume. It's attracting the masses. People are getting excited about the precious metal space, and Newmont's definitely benefiting from it.
Yes, Newmont is, as you can see from that chart, it's one of the worst managed gold stocks in this sector. But why don't we take a look at one of the better managed companies, and that's Agnico. And this one is also, it's had a great 2024, 2025. And it's one of the few names trading at all-time highs. Newmont, Barrick, many of the other ones are not. They still haven't taken out their highs that we saw back in 2010, 2011.
Right. Yeah, that's a really good sign. I mean, it's got a very strong chart pattern. You could look at this in a few ways. It has this huge rally up. It has this big consolidation. It's trading at this 618 level, which, if you remember, James, whenever something hits a 618 level and pauses, we almost always go up and see it hit the 100% measured move. So it's showing like it could go to about $154 to the upside. And that it's a very strong pattern. We've got this rally up. We got this giant, pennant formation where it's consolidating, and then it's broken out. It had a little pause, and I wouldn't be surprised if we see it eventually continue to go higher. So I like something trading near all-time highs, leading the sector or the space versus Newmont, which anytime it gets up here, it just crushes your dreams and falls back down for another 5 years. So you definitely want to pick the leaders, and in the high momentum plays, they're the ones that benefit the most. There's all kinds of studies that show if you're in the leading high momentum plays in the long run, you'll outperform most other strategies. And so this one's definitely leading the way.
And just for the benefit of our viewers, one of the reasons why Agnico is outperforming the other names is because 75% of its production comes from Canada. So therefore, it doesn't have the geopolitical risk that the other names like Newmont, like Barrick have. So, okay, so you like gold. Why don't we take a look at silver?
Yeah, so if we take a look at silver, it has both gold and silver are down today. We're seeing money kind of trying to figure out what it wants to do, but silver's been working its way in this uptrend. It's a pretty ugly chart in the grand scheme of things. Silver's, obviously more volatile than gold, but it is channeling. It is in an uptrend. It's just noisier. Anybody who trades it, you just have to, that's part of the game. You just have to digest those movements, and it's holding. It's bounced off the 50-day moving average. It's moving up. I think if we see gold break out to the upside, I think we're going to continue to see silver run and push higher. I think the next stop for silver is about 40.80. That's where that next little run could bring us, but it could obviously go a whole lot higher as things unfold. But again, I think the precious metal space is in favor. I think, I like physical gold the best because it's got this most solid chart pattern. It looks like it has a nice explosive move. It's a global play, meaning the whole world, when it gets nervous, tend to move to gold. Silver and miners tend to be a little bit more of the speculative players, more North American driven. It's not showing like overall, global fear as much. So they can both work very well, but silver it's in the upper end of its range, and we just have to see how it goes. I'm not a big fan of this chart at the moment. I don't like how it's kind of had broken some lows here. It's volatile, but overall, if it continues to hold this move and consolidate through this range, it's going to build another launch pad to want to shoot higher and take a much bigger run.
Yeah, I have to admit, silver's been one of the most disappointing assets or commodities there is. It's just, I don't know. We're always talking about taking out its all-time high of $50, which was set back in 2011. And if you adjust that for inflation, what's the number now? $75? Like, I don't know. Yeah. You and I might be dead by the time that happens.
You never know. I hope not. I mean, people have been talking about. I still think in my head, like I don't know why I have this, but I actually have like silver in my head around 270 and like $400 from an analysis a long time ago. I mean, that's obviously like a dream value, but I have if things were to unwind and the whole perfect scenario like blows up and it's good for precious metals, I think silver's got a lot of powder. And I think that's why a lot of people stack silver. I mean, as we know, there's a lot going on in the silver space that if that whole weird stuff was to unfold, silver should shoot through the roof. And it can obviously go parabolic. Like, look at the run that we had back over here. I mean, geez, 180% in no time at all. So I think silver, is going to have some huge explosive moves. It's just a matter of when. And you got to stomach a lot of noise and a lot of wasted time until it gets there. That's what I don't like about this space sometimes is you have to wait years for things to unfold. And so I only really get interested in them when they're in an uptrend, when they're showing signs of strength. And I'll pay a higher price knowing it's going to quickly run and hit some targets versus buying it and holding it for a decade and, having that belief and that it's going to go higher. I'd rather just catch it on its way up, get in, get out, and then use the money in another space when something else comes up that's timely as well.
So the price of gold is just a function of interest rates, inflation expectations, and also the U.S. dollar. So why don't we take a look at the U.S. dollar as measured by the DXY index and get your views on where this thing's going, because the U.S. dollar is down 10% on the year as measured by the DXY. Do you think it's going to continue going down?
I think it's carved out a bottom. I mean, it was one of, or it's maybe still is one of the most hated assets. It's put in a top. It's broken down. It's had what I call an impulse move, James. If we zoom in on the price action here, an impulse move is when a rally takes out two previous resistance levels. So here's a standout high. It broke through that ceiling. And it broke through this previous higher high as well. So when a move hits, you get a strong impulse to the upside and it busts through two areas of resistance. Usually after that, it's going to pull back, it's going to consolidate, and then it should want to start to continue to go higher. So the trend of the dollar has gone down, more or less gone sideways, and now I think it's starting to head up. It has still a lot of work to do here, and it's just kind of out of favor at the moment, but I do think it's turning a corner. And we saw this back in 2000 and if we go back to 2008 back here and we look at the US dollar index, you can see the dollar has been going down. It's one of the most hated assets. Is this green line here. Hold on one sec. And then we've got the right-hand chart, which is the dollar is sold off all this year. And nobody's wanted it. So we're in a very similar situation. Stocks near all-time highs. Gold is bullish and running to all-time highs. The dollar's the most hated. And I think it's just a matter of time before eventually this dollar starts to turn around and it'll go up as the economy collapses. And it'll put some pressure on gold, but we're not there quite yet.
But if you go, when I'm looking at this longer-term chart here, it looks like it might meet with resistance at, what is that, 100 or 101 on the DXY? The only thing I would say is, I mean, the dollar is just a function of interest rates. And so the president, of course, wants to get interest rates a lot lower. And that's probably going to happen in the coming months or quarters, right? So if the interest rates go lower, chances are the U.S. dollar is going to go lower, and that's bullish for gold. Based on price action, if we zoom, look at the U.S. dollar index here, we've got, it's kind of doing what silver does. It's a pretty ugly chart. It's channeling to the upside. It's kind of at the lower end of its range. I do think if we go into uncertain times, we're going to go into kind of like the tech bubble where we'll see the dollar shoot higher. In the 2008 financial crisis, the dollar shot higher. I think if we're going to go into another one, I think we'll see the dollar, push back up. And that will definitely mute some of the movement in gold and stuff. But we can see the dollar and gold move up together short term, potentially over the next month or so. Maybe the dollar kind of finds more of a bottom and trades sideways and gold keeps moving higher. They generally have an inverse relationship when big trends start. So we'll just have to see how that unfolds. I do think gold eventually will have a significant pullback
with the economy and with the rising dollar kind of pulling on it.
And Chris, are we able to pull up a chart on the 10-year?
Yeah, let's take a look at the
Just
10
to see what's happening there.
So the 10-year, like when you look at it from just a pure technical standpoint, now this is the monthly chart going all the way back to the 70s and the peak in the 80s, clearly put in a massive top, and then it broke down into a stage 4. You could argue here it has put in a stage 1 base through here. And now it is starting a stage 2, which is a bull market phase. And you and I have covered this on this channel before. If we take a look at the market, there's 4 stages. And more or less, it put in a major top. It went into a stage 4 decline. And now it's kind of bouncing bottom and starting to start a stage 2 bull market phase. And, this is a long-term chart. This chart is pointing to, it really, from a technical standpoint, it's pointing to $8 or 8%, which is huge. If that happens, obviously we're going to have like a massive financial crisis, which I do believe is coming. Not saying 8% interest rates are, but that's what the chart is pointing to. It's pointing to fear. It's pointing to lack of trust, and interest rates have to go higher for people to take the risk. And potentially inflation lingers and may be a part of it. But there's a lot of big things unfolding right now, huge moves. And I mean, that's usually what happens just before and during a big shakeup in the financial system, right? So if this was to go higher, we're going to see bonds continue to fall. A lot of people have been picking the bottom, trying to pick a bottom in bonds. And, bonds could get absolutely annihilated again. They're down, they fell about 40+% from their highs, just as COVID was happening. And if the rates do go up, it's going to put a lot of pressure on them. So that's my kind of take on yields is be aware. It has got a very strong chart pattern pointing to higher pricing still. Hopefully we don't see that because it's going to wreak havoc across the board. And obviously the U.S. will never be able to pay their debt for sure. But the markets are going to do what they're going to do. And just like, oil going negative, nobody really thought it could happen. It really made no sense. Interest rates could go up and, it's going to kill the housing market. I can only imagine what mortgage rates will be. Home prices are going to have to collapse to counter that. So there's a lot of noise, a lot of fear, like potentially in the future of a lot of things breaking and a lot of people getting hurt.
So you're suggesting that interest rates are going to go up because inflation is going up?
Well, I wouldn't say it's just that. I mean, I think there's a lot of other things at play. I'm just saying from a chart standpoint and what other assets are doing, like strong gold, that there's something when gold is as strong as it is and it has this bullish chart pattern that is pointing to another big move higher, it is signaling something bad is about to drop. Something's going to hit the market and we don't know what it's going to be. Something's going to default, something's going to blow up, and gold's probably going to shoot higher and we could see yields spike up, or I don't know. All I'm saying is this chart pattern is pointing to higher yields, and gold is telling us that something bad is brewing also. And that's just my point of view. I don't tie it really to inflation so much, but it's probably a small part of why the yields are up and staying where they're at.
Okay, so we cannot have a discussion on gold without talking about digital gold or Bitcoin. Let's pull that chart up and get your views.
Yeah. So Bitcoin, this is still the monthly chart. I'm going to drop to the daily chart here. Bitcoin's has a really nice move already kind of happening today. It's really kind of bucking the trend. We got gold down 2.5%, Bitcoin up 3%. So they're moving inverse to each other. There's times also, as you know, James, that when the NASDAQ rallies, Bitcoin rallies. When the NASDAQ has a big sell-off, Bitcoin has a big sell-off. We have been seeing that decouple over the past week and a half. Sometimes they move together, sometimes they don't. That is one of the things that make Bitcoin and also precious metal miners difficult. You never know if they're going to move with the stock market or against the stock market. And so it throws this extra little bit of risk in there. You don't know if it's going to pan out or not. But Bitcoin is pointing to roughly 136,000 per Bitcoin. If it can hold a breakout and start to run, that's the next level. We were long Bitcoin a couple times. We recently got out. We got in right over here. We trimmed some off somewhere over here, and we sold some right over here. So it's kind of trading almost where we got out of it. Now we're going to wait to see if the stock market gives us a new buy signal, see if Bitcoin itself also gives us a buy signal. And if it does, then we want to play this move to the upside, which, at this point, it's about a 12% move, which, for Bitcoin is actually not that exciting. Usually Bitcoin, you want like a 40% move or more for it to kind of get you pumped for it. But that's where this next leg is pointing to. And it might be something we take advantage of. The nice thing about Bitcoin is it tends to be a crowded play, a herd-driven move. So when it does start to break out and starts to get some media, typically our strategy also picks up on the momentum. Everybody piles in and you get one of these. You get like a 4 or 5 day move where it pops up and it hits those first targets really quickly because everybody piles in at the same time. It gets maximum coverage. As you know, if you own a business, marketing is almost everything. Bitcoin and is one of them specifically that is marketed. It's on all the news outlets. It has 1 million people talking about it. And so when it does break to new all-time highs, it gets all this free exposure and it just lures people in to buy Bitcoin. And so you get these really strong impulse moves and rallies. And that's what I like about it is you can get in, it screams to your targets, and then we can get out and wait for another setup. I like those imminent moves.
Yes, and to your point, a lot of people refer to it as digital gold, but it really isn't. It's just it's highly correlated with the NASDAQ, and when it's making new highs, it's just a risk-on trade, and that's where the money's going. So this bodes well for the market, this move.
It does. Yeah, this could be a little bit of a leading indicator, although, it's changing its relationship to the markets here almost daily here. So it's hard to get a grasp of it.
And the other big tailwind, too, behind cryptos in general is the current administration is all in on it. So I think that bodes well for the sector. Okay, so we pretty well touched on everything. The one thing I want to ask you about, one more commodity, and that's oil. And this has been somewhat volatile here in the past year, trading between $60 to $70 a barrel. What's your take here? Where do you see it going?
Yeah, so we saw the big breakdown in oil below this kind of like 67, 66 area back over here. We saw that it was bouncing along this bottom forever. Finally, it broke through it, and more or less, we had a news driven event. We had war bombs being dropped. It created a surge. Usually, we see gold and oil take off during uncertain times in war. So we saw this news-driven move. But really, if you were to just scratch that out and be like, okay, it went straight up on news. In fact, if we zoom in, you can see it shot up on news. And then once the news dissipated and worked itself out, it comes straight back down and it's negated. So if we were to just zoom out and look at this chart of oil, it broke down. More or less, it's moved up into resistance, into this whole area kind of where there's a lot of volume traded. So it's moved back up in there, and now it's starting to roll over. And I do think we're going to see oil go down a lot more. I think it's going to have some pause or bounce here, and then it's going to work itself back down to 57, 56, potentially go a whole lot lower still. So I'm pretty bearish on the energy space. It doesn't look the greatest. This huge spike, just get rid of it. It's really just a bounce into resistance, and it's starting to roll over. So I think that's kind of where I think oil is going to go. I think a lot of focus right now is on infrastructure. As you mentioned earlier, James, it's like, if you look where the building spending is going, it is like in power supply units or power whatever grid stuff, and it's data centers. That's where everything is. But home building, all that stuff has dropped right off. It's very, very minimal. I think this whole economy is kind of being floated and lifted and just kind of, it's in the cloud. It's about to potentially roll over and sell off. And I think energy is kind of telling us that it believes things are going to sell off. Maybe not so much an oil-driven market, but it could be a tech-driven market economy for the next little while.
So we touched on a lot of different things here, Chris, and I just want to spend the last couple of minutes summarizing your views. So we started this discussion talking about the S&P and the NASDAQ. You think right now we're at an inflection point, so you're not involved or you're not invested in the S&P or the NASDAQ. You think you're just holding back and you're waiting for a move one way or the other. Then you're going to make a decision.
Yep, correct.
And when it comes to gold, same sort of thing. You're not sure.
Exactly. Waiting for it to break to the upside. I'm bullish on it, but I'd rather pay a bit higher pricing and know it's on its way higher versus holding it in a sideways pattern. And it could take another month or so for all we know to break out.
The US dollar is measured by the DXY. You see that moving up to the 100, 101 level.
Yeah.
So you see, you're bullish on the U.S. dollar.
Yep.
Bitcoin, you're also bullish on Bitcoin. It's currently trading at 120. Where do you see it going?
136.
Okay. And oil. We just talked about oil. You're negative on oil. You see it going down to the $56, $57 level?
Yep. Yep.
Is there anything else you want to highlight?
I think that's pretty much kind of covers everything from a high level. I think we pretty much nailed everything. Yeah.
Well, Chris, as always, a very insightful conversation. And I want to thank you very much for spending time with us today. And if somebody would like to learn more about you and your various services, where can they go?
The best spot would be for them to go to my website, which is The Technical Traders, which you can see it on the screen here. My whole focus is to help people avoid bear markets and protect their retirement. And I manage my own money, and I share my exact portfolio in ETF trades with subscribers. And that's one of the best spots. Or go to YouTube, The Technical Traders. I have a channel there. I share videos on the markets and precious metals and uranium and all of that stuff on there. And you can join the free newsletter and make sure you're up to speed on educational content and all of that as well.
And we will have further details in the show notes. Chris, once again, thank you.
Thanks for having me, James. Always a pleasure. Take care.